today we're initiating on Sundance Energy. I guess no surprise to the network, given we've just done a big, or helping them to do a big placement to fund a big acquisition. And so the report will be out pre-market. We will have an ad rating and a 21-cent price target. And really looking through the guts of the business, I mean, it is a transformational acquisition. And, the headline of my report is, I'm calling it Exploiting the Cycle. And that's talking about the cycle in the oil market. And they really are. So more traditional of a resources cycle that you would expect, where we've seen violent swings in the underlying commodity price that has forced the hand of the majors in the space to change businesses' structures, assets, issued capital structures, much more markedly in the US than what we've seen here. Now, the reason for that is because we've also have a much higher traditional level of gearing in the US across their oil and gas producers. So the average gearing 12 months ago was above 50%, even amongst the largest players. So that's obviously, generating quite big swings. Now that we're entered a recovery cycle for oil prices, what these large companies are finding is that they can't recycle as much money back into new growth because there's more forced capital discipline from the market, who have the vivid memories of oil being priced in the 20s still front of mind. So lenders are tighter on them, equity markets tighter, asset markets still not fully recovered. So what's happening is that they're starting to divest their non-core or less exciting interests to focus on their real core focus. So for Sundance, that's created an opportunity because they're picking up some of that ground falling out one of the majors. So Pioneer Natural Resources, they have well flagged to the market that they're going to focus solely on the Permian Basin. So they're exiting the Eagle Ford, and the key reason for that is the fact that the Eagle Ford's been overdeveloped really in the last 5 years, and for the majors who drilled out a lot of their best acreage, it just doesn't have the run room of mass scale production growth that someone like Pioneer would demand of to be able to move the needle as a group. So they're selling ground that still has extremely high margin, high value barrels in it to smaller independents like Sundance who can pick it up. And really, for Sundance, that they go from revenue of 66 million 2 years ago to revenue of potentially $500 million by 2020 on this kind of ground. So that's transformational for someone the size of Sundance, where for Pioneer it's really just a rounding error almost. So looking at the deal, they are picking up just under 22,000 net acres in the Eagle Ford. More importantly than the amount of acres is that a lot of it is along better parts of the Eagle Ford than what they're currently exposed to. So most of their ground at the moment is in McMullen County and Dimmitt County. So Dimmitt's more frontier almost. So now that they're entering Live Oak, Atascosa, so not to go into too much detail now, but really these are right in the heart of the volatile oil window, and so IPs will be higher, productivity, the amount of oil content in the ground, the productivity again, and the costs are flat versus the rest of the county. So basically the payback periods will greatly improve across their acreage suite as they're picking it up. So really, I know we've got a long meeting ahead of us. So just to boil it down into one key risk-reward comparison, I'd say that post the deal, Sundance will have an enterprise value of around 600 million Aussie. You compare that to its 1P reserves pro forma of 113 million barrels. So that's exactly the same amount of 1P reserve that Beach Energy have. But instead of a 600 million enterprise value, Beach has a 3.2 billion enterprise value. So, that puts Sundance on an EV to reserve multiple of 5 times versus Beach on 28 times. So, and both companies have a similar level of pro forma gearing. So it just shows me that if Sundance can execute on this plan, if they can actually demonstrate that they're achieving the analogues the independent experts laid out, or the type curves, and we start to get line of sight on that earnings growth, then it should really be rewarded and re-rated quite strongly towards our price target. So we do have a big price target of 21 cents versus the current share price below 6 cents. Our price target is based on our valuation. It's fully diluted for the raising. But to get there, obviously, they need to de-risk that development profile. So they'll get into drilling more earnestly later in the year, and then do 38 to 40 wells per year next year onwards, following what's really just an infill program, given Pioneer had drilled out over 130 wells across its acreage. That's enough to give them a roadmap to where the oil is and where to target pay zone wise. So yeah, happy with the company. Very large leverage to oil, and yeah, initiate with an ad rating.